This is the Nedgroup Investments Insights podcast, where one or more of our experts explore a variety of views and insights that investors care about.
Welcome to another episode of Inside the Mind of a Fund Manager. I'm Mansoor Narker, Senior Investment Analyst at Nedgroup Investments. Today we're talking about quality, discipline, and real returns, and how to stay the course when the market is loud. My guest today is none other than Andrew Headley, all the way from London, Portfolio Manager of the Nedgroup Investments Global Equity Fund at Veritas Asset Management. Good morning and welcome, Andy.
Thank you, Mansoor. It's a pleasure to be here.
Let's start with some context. The last couple of years, we've seen serious style rotations where we've had pockets of speculative momentum and rising rate cycles where we've seen value outperform. The Nedgroup Investments Global Equity Fund's philosophy is a quality first with a 5-year plus horizon and a target of inflation plus 6 to 10% per annum over rolling 5 years with capital preservation upfront. For investors who are judged by recent months, particularly when it seems that quality as a style has been out of favor, why is that long-term real return lens is still the right one?
Thank you, Mansoor. I think that's a really interesting question. So I've been investing now for over 30 years, and I've seen cycles in equity markets go up and down. And I think what we're seeing today is a real shift into a speculative phase of the market. And what typically happens, and we've seen it twice before in my investing career, is that investors' timeframes become shorter and the fear of missing out on large equity gains takes hold, and people will invest in anything for short-term returns. Now, what we know is that over the long term, the equity market as a whole can only perform as well as earnings growth. So over the long term, earnings growth in the equity market, the returns will be broadly the same. Today, what we're seeing is companies with no revenue, companies with no profits, companies with just a business plan are performing extremely well, particularly in the US, and especially around anything to do with artificial intelligence. And that can lead to easy gains, and people like easy gains. And so this will continue for a while. But eventually, the rubber needs to meet the road, and earnings and cash flows have to come through from these investments that we're seeing. And unless those earnings and investments come through, then a lot of those speculative names will perform very poorly. So we don't try to involve ourselves in that fear investing and trying to find these names that maybe are just artificial intelligence, but will struggle to generate earnings. What we focus on are companies that have genuine cash flows, that earn high returns on capital. They're quality companies because they have strong competitive advantages. And it does mean in periods of speculative fervour that we will underperform because these names that garner the imagination of investors will do particularly well during that period. And all I can say to investors is to hold their nerve, because my experience of this over more than 30 years is that eventually companies with high returns, high cash flows, high earnings will perform well.
Indeed, on that point, I think I've seen a stat where the best performing stocks last year were unprofitable tech. When we look at something like the Nasdaq, right? Coming back to quality now, you define quality holistically, considering factors such as competitive advantage, pricing power, and strong free cash flow combined with strong capital teams. Can you unpack how you measure these and how they continue to inform conviction?
It's another really good question. And the key really out of all of those metrics is the strong competitive advantage. And obviously that's the most difficult to measure. Measuring free cash flow, measuring returns, that's a simple mathematical thing. What's much more difficult is understanding what a company's competitive advantage is, and more importantly, perhaps, understanding how durable that advantage is. So we see companies today and we look at them and we can't invest in them, not because they don't have strong competitive advantage today. A great example here would be the world's largest company today, NVIDIA. It has wonderful, strong advantages today. But to buy it today on its current rating, you have to have some conviction that its competitive advantages will extend over 10, probably 20 plus years. Okay, in a fast-moving technology industry where one of its strongest barriers to entry is its software, proprietary software called CUDA, and AI itself is particularly good at writing software. So how will this develop over 20 years? And it's impossible for us to know. I don't understand how any investor really has a good, strong view as to the durable competitive advantage in 15, 20 years of NVIDIA. But if you buy it today as a long-term investor, that's the bet that you're taking. And so actually of those metrics, for us, the most important thing is the competitive advantage. And so we seek to identify what the competitive advantage is. Hopefully it has more than one. Hopefully they're overlapping. So for example, you can have a company that has strong network effects, but strong network effects on their own is actually not a very strong competitive advantage. What you really want is a strong network effect together with a switching cost. And if you have both of those two things, then you have a very strong competitive advantage. And then you have to assess how durable you think that is, how difficult it is for other competitors to breach.
You want companies that are willing to win as long as possible, and you want visibility to that, right?
That's correct. So it's our analogy in the office is a speeding train. So we're looking for companies where it's a train that has momentum and it can continue to accelerate in the long term because its competitive advantage is expanding rather than decreasing.
Okay. Given that we've seen the sort of derating in qualities of style, I think, it's probably been one of the worst performing styles over the last year or two, just given that for all the points that you mentioned now, investors have been ignoring this durability and, predictable business models. Investors often ask, where is the pent-up performance going to come from? Sort of without naming recommendations, what type of businesses or themes in your portfolio do you believe have sought return potential, and what unlocks that return potential?
Yeah, so we obviously run quite a few themes within the portfolio, and some are performing well, and particularly the themes that are more cyclical have been performing well. So our aerospace and travel holdings have done particularly well, names like Safran and Airbus. Some of our other themes are struggling today, so I would say that the two areas in particular would be healthcare, and we also have, and we've been building up a position in what we would call legacy software. And we think both of those areas have a lot of potential for performance. Just taking them briefly in turn. Healthcare, it tends to have high returns. It tends to be well protected with strong competitive advantages. It's historically had good underlying growth because more people are living longer. And as you live longer, your requirements for healthcare services increases dramatically. And so you have this very steady long-term growth underpinning the industry. What we've seen since COVID really has been that there's been a COVID hangover together with some policy that has come particularly from the Trump administration, which has masked the underlying growth. So we've had 3 or 4 years where the underlying growth of the industry has been a lot lower than we would normally anticipate. Now, we think that those factors are going to decrease. And so we think that sort of the foot on the brake that we've seen from both the COVID hangover, where inventories got overbought, together with these other policies such as tariffs, we think that foot on the brake is being released. And so we think that we're going to see the underlying growth come through. And of course, because we've had 3 or 4 years with low growth in healthcare, what's happened has been the valuations have compressed because people think it's now a slower growth sector. But we think as that growth comes through, the foot off the brake analogy, we will see the valuations expand. So we'll get faster growth matched with higher valuations in healthcare. So we're pretty confident about healthcare. Legacy software is a very interesting area. So the current perception by many investors is that legacy software is going to get killed by artificial intelligence. And to be fair, artificial intelligence seems to be quite good at coding and programming. So it's an understandable worry. We feel that legacy software is not built equal, however, and that some legacy software is particularly well entrenched and therefore well protected against artificial intelligence. And perhaps the best example here in a position we've been building recently is SAP. So SAP is a German software company. They're the market leader in what's called enterprise resource planning, ERP software. And so this is kind of the brain of a company. And typically it's involved in complex manufacturing. So aerospace in particular uses it, healthcare uses it, pharmaceutical companies. This software connects everything within the company. So it does everything from ordering, inventories, receivables. It's linked into the financial system. I mean, it literally is the kind of the brain of the organization. Now, these companies, and we've spoken to a lot of them, are never going to take SAP out. It's the complexity. It's mission critical. Okay, so the idea that an AI system can come in, write some code, and simply connect these massive organizations and produce the information that they require on typically what is a 5 nines basis, which means it has to be 99.999% correct. Okay, so it's allowed one error in 10,000 data points. It's really unlikely that AI will be able to come in and do that. And so we don't think that all software is created equal. We think some is much better protected, but all software companies have been hit hard by AI. So their valuations have declined substantially. And we feel that this is a really good opportunity to buy what are high-quality companies, high returns, high free cash flow generation, what look like historically low valuations.
I love the point that you mentioned that they're mission critical, speaks to their stickiness and that competitive position and pricing power that they can command, right?
That's correct, yeah.
I love that. And finally, Andy, if investors can remember one thing from today, what should it be?
I think the most important thing is to remember as a long-term investor that markets go through cycles, and eventually the equity market and earnings have to perform in line with each other. So you can't have an equity market that constantly outperforms earnings, because then the valuation expands to a point that it's just unsustainable. And so today what we're seeing is lots of companies performing very well with no earnings and no revenues, and it's a speculative time. Eventually that will correct. And so as a long-term investor, what you want to try and do, and one of our focuses is to protect capital. Okay, so we're here to try and deliver very good returns. So our average since the inception of this fund is CPI plus 8.5. And we want to do that in a way that protects capital over the medium term. And so people need to think about their full exposure and how they're going to protect themselves if this speculative fervor comes to an end.
Thank you for your insights and analysis today, Andy. It's been enlightening to hear how you and your team have navigated the complexities of the market to deliver long-term results. Thank you for joining us, and I look forward to talking to you again over the coming months as we talk about the key issues occupying your mind and the minds of investors. To our listeners, thank you for tuning in. Until next time, stay informed and stay invested.
This podcast is for marketing purposes only. The information contained in the podcast or video was for information purposes and does not constitute advice, recommendation, or an offer or solicitation to purchase or sell any funds or strategies to any person in any jurisdiction in which the offer, recommendation, or solicitation to purchase would be unlawful.